Reid, part of your role is the design of ESG indices at S&P Dow Jones Indices. Can you talk us through what sort of process is typically entailed when creating a new ESG index?
Sure. So, first of all, the question is there demand for a new index? There are actually thousands and up into the millions of different indices. But we need to make sure as we create new indices that they're relevant to the market, that they reflect a certain view when it comes to the market. So that's the first question is there demand or a need for a new relevant index? Once we determine that there is, then there's the question of what area of the market is it going to cover? Is it going to cover, say, many countries, developed markets, emerging markets, or is it going to cover a single country? Then the question is it going to be broad? Is it going to be an index that is going to be comprehensive and expansive? Or more narrow and focused on, say, companies that are best in class from an ESG perspective or some other metric. But when you get down into ESG metrics, then a lot of other considerations come into place. Just what is it that the ESG investors are interested in from a values perspective? Are they interested in carbon emissions or looking at ESG more holistically? And so we need to get down into the data and consider what that will determine in terms of how the portfolio is going to look, how the index is going to look. Are there certain industries or certain business practices that should be excluded based upon the preferences of those ESG investors? Many ESG investors do not want to see, say, companies that are involved in tobacco or controversial weapons in a given index. And so we want to look at those criteria, perhaps make some of those exclusions. We also want to look at companies holistically and see how those companies are doing when it comes to their overall ESG performance. And all of those criteria come in to determining what the composition of an index would be and whether it's going to suit the needs of ESG investors.
Yeah, awesome. Cool. So, obviously, one part of being able to create ESG indices in the first place is having all the data available and companies ultimately reporting that data. During the time you've been involved in the creation of ESG indices, how have you seen the willingness of companies to voluntarily report and disclose change?
We've seen a significant change when it comes to different companies wanting to report their sustainability credentials. We run at S&P Global, our parent company, the corporate sustainability assessment. It really is the standard when it comes to how a company is doing from a sustainability perspective. And through this assessment, we collect 600 to 1,000 data points. Many of those public, but many of those coming from private data that companies have. And so through this assessment, we're able to collect an incredible amount of data. It takes a high commitment from companies to report all of this. Last year, we saw a 20% surge into the number of companies that were willing to fill out this assessment. We still use this assessment when companies are not engaging with us. We employ our own analysts to collect information, but it's always better when companies are willing to voluntarily provide that in-depth information. This year, we're undertaking that assessment again, and it looks like we're going to have somewhere around 25 to 30% increase, a 25 to 30% increase in terms of the companies that are responding to that assessment. And so it just shows how relevant this is, not just for companies in terms of their performance, but in terms of accessing capital markets and ensuring that investors understand how companies are doing from a sustainability perspective. So we've seen just huge interest and huge increase in terms of providing more information beyond the traditional financial statements, the income statement, the balance sheet, and so forth.
Yeah. Yeah, fascinating. I guess, on that, what is one of the biggest opportunities that you see in the sustainability space for either the companies involved or the institutional or retail investors?
I would say it is to drive change through investments. So I would say that many of the early days of ESG investing, it was about, say, protecting one's own portfolio, protecting their investments, either an individual's investments or an institution's investments. But now we're seeing that it's going beyond that. It's a proactivity in terms of wanting to assert certain values, certain changes in the market that are really going to uh, evolve how the market performs overall. And these indices are key mechanisms for doing that. And so, it's going beyond protecting oneself, but driving change within society, within communities, globally from an environmental perspective, so that the, the world is better, but also markets perform better in a way that is going to drive positive change.
Yeah, awesome. And on the flip side, what do you see as one of the biggest challenges in the ESG investing space?
Some of the challenges are that many of the data sets, I would say, struggle to be fit for purpose, meaning that as you go out and collect that data, it has to be relevant at the industry level. How you look at sustainability when it comes to a company that's involved in, say, restaurants versus one that's involved in metals and mining or one that's involved in pharmaceuticals, the factors that are material in terms of their performance from a sustainability perspective are very, very different. And we look at materiality in the sense of whether there's the chance of a particular issue to come up and the level of impact it would have should it come up. And in our case, we've been involved in collecting this data for over 20 years, and that data has fed into real investment processes. And through that process, that iterative process, we've been able to identify those material factors, industry by industry. And some of the data that feeds into the investment process in other cases that we see in the market isn't quite that honed, isn't quite that granular, and in that presents
Mm.
risks to investors that there is not the level of quality of data that should be feeding into the investment process. I would say another key element is having data that is timely. So some of the data sets that you
Mm.
see out there, uh, you see a collection from public sources, which is good. We also collect from public sources, but there needs to be a driving of the type of data that is being revealed from companies. And because we have that direct engagement with companies, we're able to ask them difficult questions uh, and drive disclosure that they may not have pursued on their own. And with those questions, we're able to drill down into issues like gender equality, not just at the top level of a company in terms of its board of directors and its top management, but going down into the mid level managers and then the general workforce, looking at whether the pay ratios are in line with what they should be, where there's general equality
Mm.
between men and women. So those very sensitive issues, by having that direct engagement with companies and building a data set that reflects that information in a timely way, that's critical in feeding that data into indices and developing indices that are highly relevant to the market. There's different studies that speak to how, say, 30, 40 years ago, if you look at what was driving the valuation of companies, it was
Mm.
85% around tangible assets, the factories, their inventories,
Yep.
these things that you physically see. Now you see an inversion of that where um, only 15% is really tied to those tangible assets, and around 85% is tied to intangible assets. So, this rings particularly true as you look at uh, the emergence of tech companies. It's not the physical assets. It really is
Yep.
all the different elements that drive interest of the market in those uh, in the services of that companies, and it's not just tech companies,
Yep.
but many different companies. And so it's
Mm.
critical uh, that investors, the companies themselves, are looking beyond those physical elements of a company, looking beyond what you see again on the balance sheet, and are
Yep.
looking at those intangible assets and the way that companies are interacting with a broad set of stakeholders.
Yeah, it's fascinating. It is really fascinating that. So I mean, as I sort of alluded to at the start, the climate change factor, I guess, for New Zealand and how that's impacting the investment community and financial services is a very hot topic at the moment. So I know people will be really interested to hear about carbon emissions, particularly because there's quite it can be, at least within New Zealand, a little bit of a challenge in terms of figuring out best ways to offset costs associated with that, various different factors. So how are companies with high carbon emissions addressed in your ESG indices?
Well, there are definitely certain companies that are simply excluded from our indices. A very common exclusion is, say, companies that are involved in production of thermal coal or generation of electricity from thermal coal. But more generally, it's more common that those companies are retained in an index and are given a chance, so to speak, to improve their standing relative to their peers. And we have many indices that are tilted, so to speak. So there's a tilting toward those companies on an industry by industry basis that are doing better, and a tilting away from those companies that maybe need to up their game, so to speak, and do better relative to their peers. So in general, we
Yep.
see a shift away from just broad general exclusions to more of that practice of tilting. But there will always be a place for indices, of course, where there are some broad general exclusions.
So naturally, we're very excited that S&P Dow Jones is launching the first S&P NZX Portfolio 50 ESG Tilted Index. What has changed in New Zealand, but also other markets, to enable the creation of new indices such as this? Is it mostly things like better reporting and access to data?
It's definitely the case that the increase in data availability, companies more conscientiously reporting, putting richer data into the market, that has enabled these indices. But I would say it's also a broader trend where uh, the values of investors are really driving interest and demand for these indices. It's the values of investors that are driving the reporting. And it's used to be the case where, say, if someone wanted to express their views, they did it through their votes in elections, and maybe elsewhere, they didn't really bring their values to bear. But now we see, of course, people and institutions, they're expressing their values across many fronts. Individuals, in terms of the cars that they drive, the purchases that they make when they go to the store, but they're not stopping there. They're bringing their values with them in the investment decisions that they're making, and that has really driven demand for indices like this, and has created the conditions where they've become highly relevant. And it's not just a passing trend, but this is something where we're going to see more and more interest in these types of indices, and they're going to be relevant to the investment process.
I definitely think, since getting the data and some of the information from your team around the growth, particularly and inflows, into ESG investment vehicles in the last 2 years has really been phenomenal. So you can see it's well and truly past being a fad and is very, very much a driving trend of where the world is moving to in the investment scene.
It's global, and it's
Mm,
really one of the fun parts of my job is that when I'm waking up in the morning, I'm uh, working or seeing messages from Asia Pacific, across Asia Pacific, in terms of interest in these indices. I'm seeing
yeah.
interest, of course, in Europe, where it's long been a trend that has been quite strong and is even still gaining strength. Also in the Americas, across the Americas, not just in the United States, but going down into Latin America. So what we see from an index provider perspective, and we're fortunate to have that truly global view. This is something that is truly cuts across markets and is going to be a driving force in investments for many years to come.
Well, thank you so much for joining me today, Reid. It's been really, really good. Was there anything else that you wanted to kind of add or thought that people might need to hear?
Um, just that it's wonderful to see this great trend building in New Zealand, and we
Mm.
see New Zealand in many ways as a leader in this area. In terms of how you're looking at different industries and trying to promote progress, not just among investors, but at a governmental level. And so it's a wonderful development, and we see that enthusiasm really spreading to other markets. So terrific job.